Thank you, Taylor, and hello, everyone. Before we get into the details of today's workshop, let me ask you a simple question. Why are we here? Why are we here to discuss taxes and retirement? What brought us here today? Well, I think we're here to get some answers and to hear the truth about retirement taxes. And I'll say there's some interesting realities for sure. But are you ready to hear the truth? I'm not sure everyone is ready to hear the truth, nor learn about the various realities associated with it. So we have an interesting situation here. Let me take you back in time briefly to give you a framework for today's conversation and so that you can understand the basics here. For the last 48 years, the financial planning profession has been telling people something very interesting, and that is that your taxes in retirement will go down. And I would say for most Americans, this has been very, very true. And it's been a good methodology upon which to build your financial decisions. And because of that, we have created a whole slew, as you can see on this slide, or a whole universe of tax-deferred savings accounts. So you're all aware of these 401ks, 403b, SEP, Simples, etc. And these are all created in 1974 with the passing of the new ERISA laws. And ERISA stands for Employee Retirement and Income Security Act. And that really changed the entire game for employees and how they save for money or save for retirement rather. And to me, this was a brilliant idea. But there's two words here that we want to focus on, and that is tax deferred. Tax deferred is a great concept, but what does it really mean? Tax deferred means you pay no tax now, you get a deduction on your tax return, you let the money grow, and you pay taxes when you eventually take it out. Now, this is a brilliant concept because it allows savers like you and me to let things accumulate on kind of a snowball effect, right, without having to pay taxes. It's also brilliant for somebody else. Can you guess who that may be? And I see a couple of you chimed in here. The government, right? It's brilliant for the government because now we're going to be paying taxes on a much larger sum of money. And boy, did these retirement savings grow. So if you look from 1974 through the present day, tax-deferred savings have grown to a whopping $30 trillion. That's a massive, gigantic pool of money. And that's great because as Americans, we know we need that money to retire. So it's good that this has worked. This tax-deferred concept has worked absolutely well for most Americans. But again, it's also worked particularly well for Uncle Sam. So things have changed today, right? Where are we today? So let's fast forward to the present. And we're kind of on this confluence of two different things happening. First, we're at historically low rates, right? Not only here in the United States, but if we compare the United States to the rest of the developed world, we're at historically low rates. You can see with the 2017 Tax Cuts and Jobs Act, both federal and individual rates were reduced, right? And so we have this reduction in rates, but spending continues on, right? If you look at the individual rates, it was kind of a modest decrease across the board. The biggest change was the corporate tax rate going from 35% to 21%, which represents a 40% slash in rates. And as you can see here, individual rates is set to expire in 2025, but this corporate rate cut is actually permanent. And so, like I said, we have these low rates, but spending continues to go on, and that is the problem. The problem is that the tax revenue coming in for the government really is only going to be enough to cover interest on the debt, let alone pay for the services themselves. I know it's old and any new services. So if you look at this chart, it's pretty telling. The federal debt is now 123.5% of gross domestic product. It's or production rather, and it's projected to be 219% of 2040 by 2049. You see, World War II was the last time it was at its highest. It was over 100%, and so we're going to be well north of that. So the problem is simple. Imagine this in simple terms. If your family makes $100,000 per year, but you own Visa and MasterCard $219,000, think of the situation you'd be in. Think of the situation that the government is also likely to be in the future. Okay, so Don't get me wrong. I think there's some wonderful government programs out there, especially with a pandemic. But suffice to say, it's a gigantic sum of money that we have to contend with. So what does this all mean? It means that the government needs money. We are already sitting on historically low rates while the government continues to spend. And retirees, as mentioned, are sitting on $30 trillion of untaxed assets. So for the first time in 48 years, it is quite possible that your tax rates go up in retirement. And that's why we're here today, folks. No one likes taxes, especially in retirement. And as you can see from this clip, this child shares our sentiment.
Oh my gosh.
Where's all your money gone, Daddy?
Taxes. 9, 10, 11. Let me fix my houses.
But it's okay. It's part of the game.
No, it's not. It's not fun.
It's not fun to what?
It's the worst part of the game.
Is what?
Taxes.
I still find that funny. I've probably watched it 50 times. And anybody else here feel that way come April 15th when you have to write out a check? So that's why we're here, everybody. Welcome to the presentation. I think everybody needs a plan, and that's what this presentation is all about. Let me tell you who I am. Taylor mentioned my name is Todd Smith. I put my background information on the screen here so you can read that over. But I'm a resident of Colorado Springs, been here for a little bit over 12 years. I try to play golf, so I call myself an aspiring golfer. I love to read. I read anywhere between 2 and 3 books a month. I enjoy all things outdoors, like the rest of us here in Colorado. You can see I'm married with 1 teenage son, a menagerie of animals. We have Cooper the dog, 2 cats, Mouskers and Dreama, and then, of course, Laverne and Shirley, our lovely free-range chickens in the backyard. So from a professional standpoint, you can see I've been in the industry for 20 years. I got into this business because I saw a lot of family members who were just ill-equipped for retirement. And so the ability to empower people and live and help people live the life they deserve and they desire through financial planning really was appealing to me. And so over the years, I have tried to keep financial planning humorous and become somewhat of a humorous financial planner, depending on who you talk to, but also coin the phrase of I help people spend their money. Okay, so I'm going to be your guide today. I'm going to help you unpack crucial things you need to plan for. You'll hear nothing remotely related to sales. This is purely educational. It's something we do to give back to the community and be of service. Let's go over some quick housekeeping items before we get into the meat of the presentation, but this is designed or organized, if you will, into 4 key points. Okay, each key builds on the other, and so you just need to be looking for the potential pitfalls and then the potential solution that goes with each. I've included many resources in the Q&A box found on the right side of your screen. So you'll see one in particular that's called How Tax Planning Changes During the 4 Stages of Retirement. That's a summary of today's content, so refer back to that as needed. You also can put questions up in that area too, if you have them along the way. There's a lot of information to cover today. I'll go as quickly as I can to get it done within an hour. We will be sending out a recording at the end, so if you miss something, don't worry about it. We will get that to you. You can also sign up on my calendar. There will be a pop-up box that you can get onto my calendar at any time for additional questions as well. Don't worry, if you click on that, it does not take you out of the presentation. You'll stay right in the system. So again, there's a lot to unpack here. I ask that you keep questions to the end, so I'll try to answer as many as I can at the end. So either jot them down and ask at the end or put them in the chat box and we'll be monitoring them. One more thing that I need to mention is everybody's tax situation is different, and so you should always speak with a qualified tax professional. So there's many topics like you see here: traditional IRAs, Roth IRAs, and especially taxes, state taxes. that maybe are germane to your situation that we can address. So many people are dialing in from many states, and so each state has different rules. We're only covering the federal tax implications, but either way, you want to talk to your accountant before actually utilizing some of these strategies. I don't provide tax advice. What I do is create tax plans and financial plans and identify areas where taxes will have an impact there. Okay. So before we move forward, I just want to take a quick poll, kind of understand who's here tonight and what your greatest concerns in retirement may be. And let me just give you a second there and see how the results. I just need to look over here. Give you one more minute. And so it looks like, number one, it looks like 80% of you are concerned about running out of money in retirement. About 10%, the other 10 or 15%, it looks like, are paying too much in taxes. And then the unexpected health care cost comes in third. Okay, so thank you all for answering that. And so let's start into the content more with our first brain teaser. And we love tax brain teasers, as my wife would say. It's as much fun as dental work. So here we have Bill. All jokes aside, this will be relevant as we move through the presentation. But Bill's been working his entire adult life. He's 65. He finally retired. He's in the 22% tax bracket because you can see his income is $41,825. On the right, you can see he just gets over the $41,778 to put him in that tax bracket. He also has $38,000. This includes $38,000 in IRA income, plus he has $25,000 in IRA income, or Social Security income, rather. I'm sorry. So him being an avid country and Western fan, he wants to travel to see somebody in Nashville, right? So he wants to spend an extra $1,000 from his IRA. So the question to you is, if he takes out an additional $1,000 from his IRA, how much tax is he going to pay? Well, if he's in the 22% tax bracket, right, he should pay 22 cents on the dollar. So that would come out to $220, right? And so let me see, does anybody answer this question? Yeah, people are saying 220. Well, if you answer that, I hate to tell you, you were wrong, because thanks to the madness of our tax code, the unique formula that determines how Social Security benefits are taxed, and some of the trappings around that, the real answer is that Bill owes $407 on that extra income. And that, folks, is 40.7% at the federal tax rate. Now, as I mentioned before, we're not really covering state tax, but if that's in Colorado, that would be an additional 4.55%, bringing up the grand total to 45%, over 45%. So I bet you, in this case, he was going to see Willie Nelson in Nashville. I bet you if he had known this, he may have thought twice about going seeing Willie Nelson. However, Willie Nelson probably won't be with us much longer. So this is a perfect example of our goal here. Our goal here is to understand the retirement distribution game, right? Spending assets in retirement. It's much different than the accumulation game. So here in Colorado at the foot of Pikes Peak, we can use the mountain analogy. You've been climbing the mountain towards retirement for many decades, right? And so you've kind of learned to save and invest, and hopefully your retirement assets have built nicely. But on the way down the mountain, there's entirely different factors than going on the way up. We now have to look at how to spend your assets, how to be aware of taxes. And so that can be dangerous. And we're going to be talking about tonight, a lot of that today. And so other things happen in your life. Your life is changing now that you're getting older, right? From a tax standpoint, as you can see on the slide, you no longer have child tax credits, for instance. Children are probably grown and gone. You've also probably paid down your mortgage or have no mortgage at this point, so you're not getting a mortgage interest deduction. You're not getting tax-free employer-paid health insurance, and you're probably not saving for retirement anymore, so you miss out on those deductions. And then some of the new things coming up is you have to contend with when to take Social Security and how that income is going to affect your taxes. You have to take required minimum distributions, RMDs, and then paying for Medicare, long-term care, et cetera. The list goes on, folks, and there's many things, as you'll see, that you have to contend with coming down that proverbial mountain compared to when you've been climbing it. And I always joke with people, if you think taxes are complicated, and of course dry while you're working, they're probably twice as complicated when you're not working. Let's stop there and do a quick poll again and see how you feel about your assets lasting a lifetime. And so the question is, are you confident your taxes will last a lifetime? I'll give you a minute to answer that. And it looks like most people are not confident. I think you come in about 75% are not confident your money will last a lifetime. The rest are fairly confident. So that's something we definitely need to improve. Okay, so that brings us to our simple statement about the problem and then the subsequent solution. The problem is people end up paying more in taxes than they should in retirement because it's a confusing system, and then there's hidden tax and penalties, as we'll see. Okay, that's the problem. And the problem is, if you pay too much in taxes, guess what happens? You tend to spend more of your retirement assets, right? And coming out of retirement means more taxes, and then you spend more, kind of this cyclical conundrum, and you spend your assets down in the accumulation phase, or you spend your assets down in a lot faster rate. So I was getting ahead of myself here, but the accumulation phase, as you know, you're building assets, saving in different forms: stocks, bonds, real estate, pensions, your own business. In the distribution phase, your wages stop, and now you have to figure out, well, which of these assets do I spend first? At what level? What is the tax going to be of each? And so the timing of asset sales and choosing which ones can have dramatic impact on your tax bracket. And poor choices through either misunderstanding or ignorance can really have an impact on people paying more taxes than necessary. So that's why we're here again today. We don't want that to be you, and we hope to clarify how this works and point out pitfalls. Okay, so that leads us to that first important step. That's the problem, but the solution is really that you need to create a plan, or as it says, develop a solution, right? Because your tax exposure will change through the 4 stages of retirement, which we'll get to shortly. You need to anticipate how traditional taxes and other taxes, such as surcharges, taxes and penalties related to Social Security, Medicare, how all those things are going to impact you. So you need to have a strategy that is going to cover all that. And so my goal is to introduce you to parts of that strategy today, show you challenges you'll face, and then also some solutions. Okay, fair enough? Makes sense? All right, so first, I also want to mention that what I consider a tax. Okay, I think you need to understand that a tax, and I say tax is an air quote, really is anything that would be increased as your income increases. So anything that is going to be assessed to you as your income goes up is really kind of a tax to me. Okay, so you really have to understand all of your retirement expenses, all these different taxes. Getting this right will help you pay as low as tax as possible, therefore making your assets last. Okay. And so we go into the 4 stages of retirement so that you understand this. Pre-retirement, where many of you are probably, that's 50 to 60. This is where you're saving and working. You're probably at your highest income level and may be able to save more than you have your whole career. The second stage is usually from 60 to 70. We call that your go-go years. You're probably traveling, doing passion work, seeing family. Next, we get into the middle retirement years, 70 to 80. We call that the go slow years. And now you have to contend with things like required minimum distributions or your RMDs coming out of your IRAs, et cetera. And then finally, we get to stage 4, which we call the no-go years, which I don't particularly like. It sounds kind of morbid, but you are slowing down, and now you're starting to think about legacy issues and estate planning. As you'll see in this presentation, there's a wide range of issues through each one of these phases, and it can be a lot harder to anticipate those and prepare for them than you think. There's a host of retirement surprises. So even the best plan will divert from reality at some point, but you need to be aware of these. Inflation, that's top of mind for a lot of people right now, but people tend to view their future costs in actually current dollars. So you have to build in inflation into any plan, okay? If you think about what the cost of, say, a gallon of milk or gas 30 years ago compared to now, that impact is going to be the same for your retirement stages, which could, again, be 20, 30, 40 years. What about longevity? Most people end up living longer than expected. So you need to factor that into your plan as well. Of course, we have economic downturns, right? We constantly are dealing with stock market volatility and the talks of recession. But have you positioned your assets appropriately to prepare for something like that? So that's a surprise that could happen at any time. And there's a specific risk called sequence of return risk that faces retirees. And it's beyond today's presentation, but I put some information in the handout section because I think it's particularly important for you. Okay. And then we have expenses. You know, I tell people that most people underestimate how much they really need to maintain their lifestyle. And who wants their current lifestyle to go down in retirement? So be as precise as possible with planning your retirement expenses when you build your strategies. And then lastly is the healthcare, the 10,000-pound gorilla. How are you going to deal with out-of-pocket costs for services, for health services, paying Medicare and other insurance costs, as well as things like Alzheimer's or extended care? Okay. So the first thing that we want to get to is our first key. What do you really need to know to get started? So our first key point is pretty simple, but you need to know what is your after-tax savings picture like before you actually retire, right? So for an example, if your 401k or IRA is 500,000, well, no, it's not really 500,000, right? Because the government has claimed that money at a later date. We just don't know what that tax rate is. So the simple example here is if you're in the 35% tax bracket or the 37% tax bracket, your money is actually worth 325 or 315,000 respectively. And of course, you have to take required minimum distributions out at some future date when you turn 72 and beyond. So obviously, the higher your tax rate in retirement, the less your account is actually worth. And this next slide is really just showing you a visual depiction of that. What this shows is a $500,000 IRA growing at 6% at various rates. And as you can see, the lower your tax rate, the more money you keep. It's simple in theory, but difficult in practice to stay in a low tax bracket. Okay. And so what you may be thinking is, okay, well, fine, my accounts may be worth less, but I still do have Social Security to supplement that, and I also have Medicare to cover my health insurance. But that brings us to key number 2. And our key point number 2 is that Social Security and Medicare also have their own tax traps that you need to plan for as well, okay? So let's look at Social Security and taxes. And so for our first example here, let's go back to our buddy Bill, right, from the Brain Tease. If you remember, he had $38,000 in IRA income, and he was in the 22% tax bracket. If you recall, he wanted an extra $1,000 to go see Willie Nelson in Nashville. Okay, but when he did that, he got hit with a nearly 41% marginal tax rate, or $407 on that $1,000. Okay, what's interesting I want to point out here is that only two things changed, right? Or one thing changed. So if you look at the left of the screen versus the right, the before concert trip versus the after, it was only $1,000 difference, okay, from scenario 1 to scenario 2. He took an extra $1,000 out, okay. But if you look in this next slide, that extra $1,000 of income actually changed both his adjusted gross income, you see that there, the AGI, and his taxable income by $1,850. So he's actually being taxed, instead of on $1.85. And so you might be perplexed why that would be happening. But here's the deal. The deal is, depending on how much income you have, other income, I should say, they call that provisional income, other income outside of Social Security, the amount of your Social Security benefits that are taxable will vary, right? For instance, if your income is low enough, then all your Social Security income could be tax-free. But if your income is high enough, alternatively, then up to 85% of your Social Security could be taxable, right? So Bill finds himself in this latter scenario. So after he took the trip, right, every dollar that he takes out of his IRA not only adds $1 of IRA money to his taxable income, but it also adds an additional 85 cents of taxable Social Security. So that, folks, is what we call, Bill was getting hit by what we call the Social Security tax torpedo, okay? So if you add all that up on this screen, you can see how we arrived at 40.7% real tax rate, okay? And so this is a perfect example why you need a plan, okay? Why you need a strategy. And if this is confusing, put something in the Q&A box, and then you can also click on my calendar link below if you want to talk one-on-one, okay? So looking at another aspect of Social Security and taxation, we have to look at how people approach retirement. And we know that some people retire altogether. Other people work part-time, which I think is more and more common these days because people are living so much longer. But sometimes people semi-retire and they work less hours at their existing job. Sometimes they volunteer while still working. There's definitely many ways that people retire now. So working in retirement, you need to be aware of and how that affects your taxes. Okay, so we've broken this down into the good, the bad, and the downright ugly. And so let's start with the good. The good thing is as follows. So you've probably looked up your Social Security benefit. If you haven't, you should go to ssg.gov and find your benefit. But what you may not be aware of is that your benefit is actually calculated on your highest 35 years of inflation-adjusted earnings, right? And so the common question would be, well, what if you don't have 35 years of earnings, right? So say maybe you stopped working sooner, or you stop to raise a family, whatever the case may be. Let's just say, suppose you have only 28 years of earnings. And so that means those remaining 7 years have big fat zeros, okay? But here's the good news that I wanted to bring up. The good news is that if you continue to work in retirement, any earnings still is going to add to that benefit calculation. So even if you were working at Walmart or some part-time job, those earnings will change those zeros to something and could increase your benefit, okay? So even modest earnings can have a positive impact. And so let's look at the bad. An example of the bad is that if you're already collecting benefits, a lot of people aren't aware of this. If you're collecting your Social Security benefits, there is a earnings limit that applies prior to reaching full retirement age. And for most people, full retirement age is 66 and a half, somewhere around there. It depends on the year you were born. Okay, so if you start Social Security prior to that date, then there's an offset. So for every $2 that you earn over a certain amount, and for 2022, it's $19,560, they're going to withhold $1 of benefits. Okay, so let me just give you a quick example. So say in 2022, if you look in the slide here, you earn $21,560. That puts you $2,000 over that income limit, and you're before full retirement age. then they're going to withhold $1,000 in that particular year. Doesn't seem like a lot, but you can imagine if you were to earn well north of that, that could be a sizable amount. Okay, two things to be aware of. First, this is just W-2 and self-employed income. This does not affect your pensions, or they do not account your pensions, interest, dividends, capital gains in terms of their earnings limit. So it's really just earnings. And then second, when you do finally achieve full retirement age, they will credit some of this back to you. So it's not a permanent reduction. So just be aware of that. And then we move on to the ugly. And the ugly is what we're talking about here, is that sometimes you pay other taxes still, right? So say you're still working, you know that throughout your career you had to pay your FICA and your payroll taxes, right? So if you're an employee, you paid 7.65%. If you're self-employed, unfortunately, this would be for me as well, you have to pay both the employee and the employer side of the equation. So we actually pay 15.3%. Okay. Now the key, as this relates to working in retirement, is that these taxes don't go away, right? So if you're working part-time, and even if you've already reached full retirement, and even if you're taking Social Security, you still pay those taxes. And the worst part, really the ugly part, is if you hit that 35 years that we talked about before, you're paying into the system, but you get no ancillary benefit. So not only do I think that's ugly, I think that's just kind of unfair. Okay. But another reason that we need to plan. Okay. And let's look at Medicare. So Medicare and taxes. Medicare, if you look at this example number 2 here, is Medicare has this thing called IRMA. And IRMA stands for Income-Related Monthly Adjustment Amount. And the key here, again, is on income, because your Medicare premiums are going to be impacted by the income that you earn, okay? Now, this tends to be for people in a little bit higher income, right? So if you earn $91,000 or more for singles and 182 for joint, is really when this starts to have an impact. But it relates to Medicare Part B, which is your health insurance, and then Part D, which is your drug coverage. Okay, so let's meet George and Martha here. And if you look at their fact pattern, they both have Medicare Part B and D, right? They made $283,500 in modified adjusted gross income in 2020. And let me point out, that's not a typo, okay? Medicare, the IRMA rules have a 2-year look back. So we're not looking at last year, we're looking at the previous tax year. So they made $283,500 2 years ago. They also sell a stock for $1,000 capital gain. Okay. So they should, based on what you probably already know, they should pay $188 tax, right? And that would include $150 because they pay a capital gain at 15% rate on the sale at $1,000. And then they also have to pay, which you may not have heard of an extra 3.8% of what they call net investment income tax, or surtax, okay? So not only do they have to pay the 15%, but because their income is high enough, they have to pay that extra 3.1. So the $38 that you're seeing there, that's where that's coming from. And let me just point out again, the net investment income surtax is again for kind of higher wage earners or higher earners. And so that doesn't start until you make over $200,000 for singles and have income higher than $250,000 for married. Okay. But if you add all that up, that's $150 plus the $38 or $188. That's 18.8%, right? Well, that's not the whole story. So what you can see that happens is that pushes them off kind of the cliff, right? And so if you look at the next chart here, on the next slide, this is the Part B IRMA chart. And so that extra $1,000 actually put them into the next tier, right? So they moved up into the tier starting at 284, which means that they are going to pay an extra $442 a month. And so if you add that all up, they're going to be paying about $2,450.40 for the whole year, just because their income pushed them into the next tier. Okay. And that's part B. And the next slide, we're looking at part D, right? And so George and Martha will also owe about another $19 each for their drug plans. That puts them to about $466 for the couple. And so that's going to be added on. Okay. So without any planning in terms of selling assets, as you can see, or taking distributions, this is an unintended consequence. And so if you look at the 1 year IRMA surcharges together, the Part B and the Part D, you're looking at $2,915 a year. And then if you add that into the other taxes that we're talking about here, we do the math for you, but you can see the stock sale plus the net investment surcharge we talked about, that's $188. Add in the Part B and D at $2,916. That brings up the total extra tax and surcharges to $3,104, just because of that $1,000 sale of a stock. Okay, and if you do the math, $3,104 of $1,000 is a 310% tax bracket. Okay, so you got to be very careful with these things. You can't just be haphazard in terms of selling assets without having a plan. Okay, something worth pointing out here is that being pushed into the IRMA tier is actually is worse than being pushed into the next tax bracket, and that's because it only takes $1. So $1 under ordinary tax rates would only be taxed at that next bracket, not all of your income, right? So if you go from the 22 to the 24% tax bracket with $1, it's only that $1 that's taxed at that next high rate. However, with the IRMA cliff, and that's why we call it a cliff, is only $1 over puts you into the next tier, and you're going to have to pay this. Okay, so something to be aware of. And let me remind you that IRMA looks at 2 years ago, right? And that's another thing that catches people off guard. So you have to have a plan. Okay. And so making sure that you understand that's important, but you also need to make sure that you enroll in Medicare at the right time. If you bungle that, this is a lifetime penalty, folks. And let me say that again, lifetime. And so let's use this example of Jim and Ann, so you can see how this works. So Jim and Ann, both 68. Jim retires at 65. Ann retires at 66. Prior to retirement, Ann's employer, or they had health insurance through her employer, but when she retires, they also offer retiree health insurance. Okay, so she takes that. What they didn't realize, though, is that they had to still enroll in Medicare Part B as soon as she retired, and they didn't know that. And so the reason is retiree health insurance is actually secondary to Medicare. So you have to have Medicare. If that has a gap in coverage, then your other health insurance would kick in. But Jim and Ann didn't realize this until it was too late. So thanks to the way the enrollment periods work, they're not going to be able to get coverage until next year. So worst case scenario is that they have a gap in coverage for a year and they have a big medical event. But even the best case scenario is that they're late for enrollment, and now they're going to each owe 10% on the base premium for their entire life. Okay, so you can see on the screen here on this slide how this translates into real dollars, right? So $408 per couple of an increased premium this year is going to continue for the rest of their life. And we know premiums continue to go up, right? Because things get more expensive. So this $408 is going to continue to grow as well. And this could easily be a $10,000 mistake for this couple. Okay. So another trapping you need to be aware of. And for simplicity's sake, we kept Part D out of this example, but that also has penalties. Okay. Okay, so we've seen how Social Security and Medicare have their own tax traps, right, and their own kind of pitfalls. So you're probably wondering, are there other tax traps we're going to face in retirement? Well, the rest of what we're going to cover really is about the plain old tax code and how it squeezes retirees. Okay, so that will bring us to our next key, our third key point. But before we do that, I want to take another poll. I believe this is our last one, or second last one. But how do you feel about taxes going up? Do you believe taxes will go up in the future? So if you would answer that quickly, I would appreciate it. Okay. Well, that was easy. It looks like most everybody thought the taxes are going to go up. We have, looks like 90% yes and 10% maybe. Okay, so that's good to know. So our next key point, number 3, is you must plan how and when to use these various buckets of money, right? Your taxable, your tax deferred, and your tax-free assets. You can't be haphazard about this, right? Timing is everything. And if you don't plan this carefully through each stage of the retirement, then you could encounter, as we've already seen, unintended tax consequences. Okay, so let's first look at one of the most common questions I get is which accounts do we spend first? So here we have Sam and Mary, and they have been good savers all along. As you can see, they each have IRAs at 400, what is it, 80,000? I can't read it. They also have Roth IRAs at 60,000, and then they have a joint account of 300,000. And so I guess it was 450. 60,000, 300,000. They want to spend about 8,500 per month, which is just over $100,000 a year. So the question is, how much or where should they be sending from first? And I'll just tell you a quick story. I had 2 people come into my office recently where they were spending from their IRA before anything else. So all their income was coming from their tax deferred bucket, even though that they had some taxable money sitting in the bank. And so for them, they're spending a lot more in taxes than they needed to be, okay? But the conventional wisdom as it ties into them as well is that we had a spending order typically, and the spending order goes like this. It's spend your taxable money first, money that's already been taxed, right? So bank accounts, non-retirement accounts, then spend your tax deferred buckets like your IRAs and your 401ks and all that, and then move on to tax deferred. So these 2 folks that came into my office kind of made that mistake when you're looking at conventional wisdom. And when we switched it around for them to spend taxable money first, we were saving them thousands of taxes a year that would really add up over time. Okay. So the thing about the conventional wisdom, however, is not always the best approach. And I always say never, never say always. Of course, I just said I always say that, but never say never, never say always. It depends. And so there's been a host of studies around this conventional wisdom. Academic researchers have really been interested in this, and what they were looking at is how optimal is this conventional wisdom. And what they found is that this conventional wisdom isn't probably the best approach. And so they looked at this example for this alternative approach, and they found that making a small change increased the probability of success and how long your money lasts. So what they have proposed is that you spend your taxable money first, like we talked about. Then you actually are going to look at converting tax deferred money, IRAs, to Roths when you're in low tax years. Then you're going to spend tax deferred money, and then you're going to move on to tax exempt money. Okay. And so what they found again is that it makes your money last longer, and that's 2 or more years that could add to your plan. And 2 years may not seem like a whole lot, but if you add up that to maybe a few other things that add another year or 2 here, it's the sum of all parts that kind of really a large impact on having a comfortable retirement. Okay. I know this gets a little detailed, but this is an opportunity. If you have questions or you want help with this analysis, we can do that. But of course, you want to see your tax professional as well. Okay. Okay. So what we're talking about here when we're this kind of subset of spending your taxable money is moving money from IRAs to Roths is really a Roth conversion. And a Roth conversion is a simple process that allows you to move money from one to the other. Okay, so it could be a 401k, it could be a traditional IRA, but what we're doing is moving it and converting it to after-tax money. And you guessed it, if you're converting it from pre-tax to after-tax, that's going to trigger a taxable event. So Jill here, for an example, she converts $100,000 from her traditional IRA to her Roth IRA. And so that $100,000 is now going to be taxed to her in that year at her rate. So it's very important, of course, to make a plan, to have a plan prior to doing any conversions, and then get the blessing, so to speak, from your tax professional as well. Okay. But what we recommend here is not always doing your full IRA. You can actually convert part of your IRA. Okay. And so a lot of people are confused by that. They think it's all or none, but that's not true. So we use a process, and we recommend a process called filling up the bracket. And so you can see from the visual depiction here, a lot of people with their other income sources are kind of find themselves in the middle of the tax bracket. And so here, before conversion, you can see this person is, halfway in between, or halfway in the 22% tax bracket. Okay, so if it's $100,000 in income, and the 22% tax bracket goes from 83.5 to 178,000, then that means this person has an extra 78,000 of income that they could so-called trigger before going to the next tax bracket. So what you would want to do is convert that amount just to bring it to the top of the tax bracket, and then stop and consider doing it again next year. And so what we found is that is a much more efficient way of not only spreading out your tax liability over a number of years, but also getting a lower average tax bracket to do so. Okay, so you want to employ Roth conversions when your income obviously is low, right? So if you're a business owner, that's when expenses are high, income might be down, or maybe you have a high medical expense year. There's also a corridor between the time you retire and your W-2 income stops, and when you start turning on pension and Social Security, etc., that you should be in a low tax year. So that is a perfect time to do that. Of course, there's advanced strategies that we don't have time for today, but for those that have 50 or 500,000 or several million in an IRA, there are discounting strategies to remove money from those accounts as well. Happy to talk to anybody about that. Okay, so the important question here, really at the crux of this, is really, are we trying to reduce income to avoid going into the next bracket, or are we trying to increase income to fill up that bracket? So that's important. Okay, there's a host of other approaches that you may want to look at. We don't have time for today, but things like QLACs, qualified life longevity annuities. I have information in the handouts. There's also Ross and LERPs you might want to look at as well. But if you have a strategy session with us or in the Q&A, we can talk about those. Okay. So we've seen throughout this presentation, we've talked about the RMDs, the required minimum distributions, that you need to start taking at 72. It used to be 70.5, but at 72, they're going to force you to take money out of your retirement accounts. Okay. One way to mitigate this, because they're all going to be taxable to you, is structuring your charitable donations. Okay, so many people we found are supporting charities, and they're spending out of their accounts, or they're giving directly out of their bank accounts. Okay, but what we're going to be looking at here is Albert and Shirley as an example, and talk about a charitable strategy that might help alleviate the RMD problem. Okay. So Albert and Shirley are in the 24% tax bracket. The new standard deduction, as you can see, for 2022 is $25,900. They get an extra deduction because they're over 65, so it's $28,700. But as you can see, their itemized deductions are only $15,000. So if you understand how this works, you're going to obviously take the standard deduction. Okay, so those $15,000 in itemized deduction, which mind you includes their $5,000 donation, really they're not getting any benefit from. Okay, so that $5,000, while I think it's good that they're giving to charity, I'm not saying they shouldn't do that. They're just not getting any tax benefit. Okay. So what we want to look at is what's called a qualified charitable distribution instead, or a QCD. Okay. And a QCD is a way of taking your RMD but giving it directly to charity so you don't have to pay tax on it. Okay. So the rules are you can do $100,000 from an IRA per person. It must go directly to charity, and it counts as your RMD, but it's not included as income. And then lastly, there's no income tax deduction. And you may be wondering, well, why is there no income tax deduction? Why am I recommending this strategy? That's because it never shows up as income in the first place. Okay. So let's look at the cost of a non-QCT contribution. So say Albert and Shirley do what most retirees do. And I had many retirees before meeting me doing it this way. So they're paying directly out of their bank account. So and in the fact pattern here, the charity still gets the $5,000. So that's their intent. So that's fine. They take $5,000 over their IRA like they're required to, so it satisfies their RMD. The $5,000 that they take out, though, is reported as income. And so the total tax cost or total cost of the charitable contribution is really the $1,200 in tax at the 24% tax bracket, in addition to the $5,000 contribution. So the real cost in this case, if you look at it this way, is $6,200. Now let's compare that to what it would cost if they implemented the QCD. So what they do here instead is they're paying the charitable contribution right out of the IRA. The charity still gets the $5,000, right? The RMD is satisfied, so they're not being penalized for not taking that. But the $5,000, because it's going directly to the charity, is excluded from taxable income. And so their tax bill on the distribution is now zero. And the total cost equivalent of the charitable contribution in this case would be $5,000 minus the $1,200. And so they did this all without ever getting the deduction. Okay. And so that's something that we recommend to a lot of people. I just had a conversation with somebody recently about restructuring their charitable contribution. They're not aware of this. So something to consider. Okay. So in addition to giving to charity, passing on assets to the next generation is also important. So that brings us to our final key point, final key, which is 4. And so organizing your assets for your family's benefit, estate planning still matters. Okay. And so what we want to look at first in this example is what is a stepped up in basis? Okay, a stepped up in basis strategy. This confuses everybody, so please send me questions or schedule with me if you want to talk about it. But essentially, a stepped up in basis is a rule, a tax rule that adjusts the value of inherited assets. So its value is not what your spouse or the person you inherited from, what they paid for it initially, but it's actually stepped up to the price on the date of death. That can make a big difference in taxes, as we'll see. Okay. So what we want to look at here is an example. Phil and Mary, right? They have a joint account, joint tenants with rights of survivorship. That means that whoever survives automatically gets the account. They have $120,000 in long-term capital gains in the account, and then they get bad news. The bad news is that Phil is diagnosed with terminal cancer, and he has 18 months to live. So scenario 1 of this example is they do nothing. Okay, they don't make any changes. So what's going to happen in terms of when Phil dies? Okay, so Phil passes. Mary now inherits the joint tenants with rights of survivorship. From a tax standpoint, she's going to receive the stepped-up basis, but it's only going to be on Phil's half, which means if she sells the entire account, which ultimately she'll probably have to do, she still has a $60,000 unrealized gain on her part of the account. Okay, so simply put, if she sells it all, she'll owe tax on her $60,000 gain. Now, suppose that once they find out about Phil's condition, they move the account just into Phil's name. Now, as long as Phil lives longer than 1 year, Mary would now receive the full step up in basis on the $120,000 account. And simply put, if she turned around and sold the whole thing, she would pay no tax. Okay. So which would you rather, paying zero tax, or would you rather owe $60,000 on the gain? Okay. So let me just say this, that, I just helped shepherd a family through this exact same thing. It was a longtime client. He had esophageal cancer. And so we really were working hard with his spouse, with his wife. And planning around death can be hard, okay? But this is where financial and professional help can be helpful, because we tend to be emotionally removed, and we can assist you in making good decisions that may be hard. So I just wanted to point that out. And things are hard. So now you may be thinking, well, I've saved up these IRAs and 401ks. I think we're going to be okay for our retirement, and we would like to pass them on to the next generation. Okay, so passing on IRAs and 401ks, these tax deferred buckets we're talking about, to the next generation used to be a good idea. Okay, at the beginning of this presentation, I alluded to the Secure Act a little bit. And so now the rules have changed since 2019. It used to be that you could inherit an IRA or 401k and stretch the distributions over your lifetime, which could be many decades. Now they changed the rule to a 10-year period, meaning anybody who inherits one of these type of accounts must take distributions in a 10-year period, okay? So it used to be called, what was it called? A stretch IRA, has now been restricted. This really shines the light on the fact that tax laws change all the time. You need to have a proactive plan and revisit it regularly, okay? So let's look at Pamela and Kyle as an example of what the choices are available to a beneficiary now that stretch IRAs no longer exist. So the first scenario with Pamela and Kyle is unfortunately Pamela passes away. She leaves the full IRA to her son. He's the only child, the only beneficiary. So now Kyle has a maximum of 10 years to withdraw the IRA, okay, to meet the requirements of the IRS. And so if we do the math here, we've done it for you. Let's just say that this account of $400,000 is growing at 6% per year. That means Kyle's annual distribution is going to be $54,347, which on the one hand is nice extra income for Kyle, but he's likely already earning and already in a significant tax bracket. So this is now going to be layered upon that, which means this inheritance could be taxed at 30, 40 or higher percent. So there's a lot of leakage there. Okay. Let's look at the second scenario. Let's just say Kyle forgets and lost track of time, and he's already reached year 10 of this required minimum distribution window. And I can see this happening to a lot of people. But since it's year 10, he now must take a full distribution. So assuming the same factors, 6% average rate of return on a $400,000 balance, he's now forced to take the full $716,339 from the account, which in this case, because of that 3.8 surcharge we talked about before, federal taxes, state taxes, is easily going to be paying 50% and more. So half of his inheritance would be gone to taxes. And so that is a key point in terms of structuring your assets before retirement and in retirement, planning for the next generation. Okay. And so we've talked a fair amount about debt. Let's talk about long-term care. Long-term care is an important topic, but for today, we're just looking at the tax side of it. Okay. Most people don't know. There are benefits with long-term care. Premiums for long-term care insurance, for instance, are tax deductible in a lot of cases. And then benefits received for long-term care can also be tax-free. But let's look at how you pay for long-term care and how that can impact your estate and your heirs. Okay. And so in recent years, there have been these things called hybrids. It's a combination of life insurance and long-term care. It's just another chassis in which to purchase long-term care. But that is typically, when people buy those, that's usually where they want to pay for the long-term care benefits. So let's look at an example in a few scenarios with Florence. Florence is a widow. She qualifies for long-term care benefits. She lives at home with in-home care that costs about $60,000 a year. To offset that, she has $20,000 in Social Security, and then she also has a $400,000 IRA and a life insurance policy with a long-term care rider to pay for the difference. And of course, most people, as noted, would want to use their long-term care policy. That's why she bought it, right? So let's look at this scenario number one. Florence uses that policy to pay for 5 years of care. Okay, say it's the last 5 years of her life. She's infirm. She needs this care. So she uses that long-term care rider. And so what will happen to her heirs? So she doesn't pay a lot in income tax because she has high unreimbursed medical expenses. And so the $500,000 policy in this case will pay out $300,000, right? So it's $60,000 a year times 5, right? That means her kids will inherit the life insurance of what's left over, $200,000, right? $500,000 policy minus what's been paid out of $300,000. So they'll get $200,000, the remainder. And then they'll also receive the $400,000 IRA. However, that's going to be all taxable as we see to them. In the second scenario, let's suppose she lives for the same 5 years, but she uses their IRA money instead. And so she still pays minimal income taxes because she has those high medical expenses. Now, by doing it this way, her kids inherit $500,000 tax-free, and another $100,000 in the remaining IRA money, which of course we mentioned would be taxable. Okay, so if you compare these two scenarios, the ultimate benefit's really unknown because we don't know her children's tax rates, but it's really hard to imagine a scenario where the tax-free money is not a better option. Okay, and so that is just something I wanted to bring to light as how you use different assets can have different impacts, not only for you, but for heirs. Okay, so we're at the end. I know we're getting close to the top of the hours and your head may be swimming. So let me bring it all together for you. Okay, we started with a clear statement here, right? Retirees often pay more in taxes because of a confusing system, and then hidden taxes and penalties. Okay, so let's go through the 4 stages as a quick review. Pre-retirement, we talked about knowing your after-tax savings before retiring. This is also when you want to consider funding Roth accounts and LERPs. Early retirement, you need to understand Social Security and Medicare rules. That's paramount, but you also want to consider filling your tax brackets in low tax years. In middle retirement, you're going to be faced with RMDs, and we talked about QCDs and QLACs as a way to mitigate that impact. And then late retirement, we just talked about organizing your assets in a tax efficient way to organize your estate and be more efficient, right? And so all these things, as you can imagine, bring us to this big obvious solution to our original problem. And that solution is that you really need a good plan in retirement. You need a strategy, likely with professional help, that's going to do a few things. First, it's going to anticipate how and when to tap your different assets that you've accumulated on the way up the mountain, right, to cover your personal expenses. 2, you need to understand the range of taxes and how you'll face it at different stages of retirement. And then 3, you need to manage your actions so that you pay the lowest tax rate possible, not like our buddy Bill, right? And so it's important. I think you're leaving the accumulation phase as we're showing here, and you're preparing to go down the mountain into distribution phase. There's a whole host of other problems. Okay, so naturally, we want you to be efficient with your savings, and there's strategies to reduce your tax burden. But with many things in life, you need to be educated, and you need some planning, and you need advice. I know there's a lot to think about. Our tax code is kind of confusing, and they keep changing. But that doesn't change the fact that why we started this tonight is you need to plan. So hopefully I've given you some ideas to start building your plan. Okay. Now let me just close real quickly by saying, folks, I do this workshop for a couple of reasons. I'm very service oriented, and first we do this to educate and clear up confusion out there. The IRS hasn't made it easy on anybody. And I hope you took away some valuable information today. But there's another reason, and it's equally important, and we would like the opportunity to be your guide. Okay, as we just mentioned, taxes and retirement are very complex, and there's dangers and challenges you might face along the way. We'd like to help you because it's our mission to serve the community, and we're passionate about this. You know why I got into this industry, but we have a combined experience of 60 years of experience helping people get down the mountain and helping you spend your hard-earned money. So if you feel it's appropriate, the next step is to schedule a one-on-one strategy session. Okay. I know there's a lot of questions here that I'm going to try to get to here in a second, but let's talk about that strategy session real quick. My calendar is down below. You can click on that to schedule this at any time. But our strategy session is really simple. Okay. It's really just an opportunity to get to know one another, to answer any questions that came out of this presentation or anything else that's on your mind. Okay. We're happy to provide a free tax analysis that we talked about in the past. You can see one in the handout section as an example. We're even happy to help you start on designing your own personal plan. Okay. Be clear on this. There's no sales involved. It's really consultative. It's just an extension of this education. I think you've learned what my style is. At the end, you'll feel happy and smart. You'll be happy because you've taken some action towards securing your future. And you'll be smart because not only did you hopefully learn something today, but you'll learn more items that are specific to your personal situation. Okay. So at the beginning of this presentation, I told you I wasn't going to sell you anything. Well, that's not completely true. The only thing I want to sell you on really is you. I know this could be daunting for a lot of people. I know it's intimidating, but the reality is that you can achieve your goals. You can take control of your future. And the best part of that is that you don't have to do it alone. My team and I specialize in this particular area of getting people down the mountain. We want to teach you and help you spend your money and enjoy the life that you dream about and have been waiting for many decades. So let's get into questions real quick. I only have time for a couple to be respectful of your time. Karen asks, is there a maximum amount that we can convert to a Roth IRA? The answer is no. The IRS doesn't care. You can convert as much or as little as you want. It's not like you can convert as much or as little as you want. You can't contribute certain amounts because there's income limits. But the IRS is fine with you converting a lot because guess what? They're going to get their tax revenue upon conversion. That triggers a taxable event. Mike asks, what is a long-term care hybrid? It's just instead of conventional long-term care where you pay premiums, but you never really ever get anything back if you don't use it. A hybrid is a combination of life insurance and long-term care coverage, so that a death benefit at least comes back to the estate if it's not used. There's more information in the handout section on that. Same for Bill, you asked about a QLAC. There's more information there as well. And then lastly, Patricia asks, how does a step-up basis work for my property? Does it work for all type of assets? A step-up basis works really for any asset. So if you're talking about your rental property or personal property, that also gets a stepped-up basis upon passing under current law. The only type of assets that really wouldn't work for is what we're talking about today, would be retirement assets. So tax-deferred assets that have not been taxed, for instance, it's all going to be taxable to the recipients. Okay, so I think that's all we have time for today. We'll be reaching out with a recording of this as well in case you missed something, and also if we didn't answer your question, I'll be following up with you personally. I want to thank you everybody for your time. Congrats on taking this first step of securing your financial future. I wish you much success, and I hope to see you on the other side. Have a great day. Bye-bye.